All right, so first off, we want to let you know we appreciate you coming to take a look at our webinar, sit through it with us. Brian and I really like communicating with the other investors, kind of sharing ideas, sharing our experiences and some of the things that we've learned. We're going to keep this to about an hour. That's going to include questions, so while we're going through this, if you have any questions, make sure and type them in. We'll get to those at the end, and if for some reason we don't have enough time, we'll make sure and get back to you by email, send those out to everybody so you have answers to your questions. And like I said, the recording will also go out as well. And so first, a little bit about us. This is Jake, and I've been investing for probably about 5 years. I started out managing international construction projects, and then I transitioned into a kind of an improvement of life, switched careers. Unfortunately, right about when I switched careers, I got informed that my job was going to be cut. Fortunately for me and my family, that never ended up happening. But that's kind of what started me down the path of investing, taking action, and taking control of some of the things that I wanted to do to go where I wanted to. And through that, I made some relationships with some people who kind of opened my eyes, expanded my investing exponentially, and I learned a ton. And so what Brian and I are kind of trying to do through this webinar and some that we're going to do in the future is just passing on some of the things that we've learned that have made us successful that hopefully you guys can use in your own business and help you guys be successful as well.
So this is Brian. So just like my brother Jake, I've been actively investing since about 2007. I started out managing large commercial construction projects in the greater Seattle area. These are $200+ million projects that I started managing. With the downturn in the economy in 2008, experiencing firsthand the effects. As an example, my wife, she couldn't find work here locally. She was actually up visiting some relatives in Alaska and found a job up there and ended up staying up there for a little over 3 months just so we could make ends meet. So definitely experienced the market downturn. At that point, I started, along with my brother, taking paths to control my financial future through investing and gaining knowledge. Gained lots of knowledge about it, but realized also that I had a passion. I just loved the investing world and also loved passing my experience on to others through investment funds, as well as this webinar as an example.
So this slide here is just kind of a disclosure one we have to go through, so I'm going to read right through it. Got to tell you what we're not. We're not attorneys, tax attorneys, accountants, bookkeepers, CPAs, broker-dealers, financial advisors, planners, registered investment advisors, realtors, mortgage brokers, bankers, or any other certification designation. And we're not selling or soliciting anything. We're just, like we talked about, people that have some knowledge and some experience and something we want to pass on to other people to help you in your business and hopefully increase your wealth. So what we'd like to talk about is volatility. And everybody's experienced that. And Brian's also going to go through near the end of the slide show something that puts dollar amounts to a hypothetical investment. We show what happens when it's volatile, then we take the volatility out of it and show you the difference. And you'll be surprised. That difference is staggering. It's huge. In that example, you all see it's actually 7-figure difference. So Brian will be going through that a little bit later. And so volatility, what is it? It's something that changes extremely, very sudden, uncontrollable, either maybe now or sometime in the future. And we've all experienced that. It's starting to happen with a lot more frequency now. 2000, you can think of the tech bubble that happened, and the NASDAQ's actually never even recovered from that tech bubble in 2000. A lot of people in real estate, and everybody's experienced the housing crash that happened in 2008, which was primarily caused by a lot of foreclosures in 2006 and 2007. And when you have that volatility, those things affect you, your financial life, they affect you personally, they affect you professionally. And it's because those changes and the volatility, they're always affected, and a lot of emotion is involved in those. And so the more volatile something is, you have a big emotional reaction to that. So that's why when you see a market go down, it can go down very quickly because there's an emotional reaction to that, and everybody can feel that. So we'll quickly go through some of the investments out there that do experience volatility. Real estate's a good one. A lot of people understand real estate because you can see it, touch it, put your hands on it, it makes sense. So that's going to be your residential homes, multi-unit complexes, commercial buildings, lands, property. Then you have individual stocks, also called the equity market. A lot of people are invested in those via the retirement plans that they have. Mutual funds, those are the professionally managed collective pool of funds from investors, and those are things you're also invested in, combination of many different stocks that many people participate in through just like the 401ks and your retirement plans again. Collectibles and valuables, those are going to be the people that hold gold, hold silver, some of the classic things that you have that have been passed down from you. So what makes some investments volatile? A lot of people deal in real estate, so you're subject to many changes in the economy, natural disasters. The example here we show is New Orleans. After flood, you can also have hurricanes, many other things that have a big impact in an area all at once. Geography, that's going to be where you live, like if you live in the country, if you live in the city. Another thing to think about would be the Midwest versus New York or Los Angeles. Those markets are going to be valued differently, and so they're going to change very differently too when the markets are going up and down. You're going to be affected by the lending regulations, interest rates, and I always say the housing market isn't so much about houses, it's more about money, because the cost of money and the availability of money is what's going to allow people to buy the houses. Seasons, everybody knows, depending on summer or winter, there's always better and worse times to be in the real estate market and buying and selling. For people out there who are landlords, you're going to be familiar with repairs that you have, usually trying to account for those, but you never know if you have a roof repair or something like that. Rent rolls, sometimes you're going to have vacancies, people moving out, people not paying their rent, so those are going to be the things that are going to affect your investment there. I did put buyers and sellers in there because that it reminded me of the first time I got a house under contract. It was the first one I got under contract, so I was super excited about it. I thought the hard work's over. Now I'm just going to sell that house. And it was actually 45 minutes away from where I live. So every time that a buyer called me up, I jumped in my car, I drove up there and said, I'm going to sell this house. But I didn't kind of realize that what happens is a lot of buyers might just be walking by your house and saying, hey, I want to take a look at the inside. So that's something that took a little bit longer for me to sell my first house. So I realized that kind of the quality and the quantity of buyers has a huge impact on the speed with which you can turn that asset and make a profit. So it's always good to keep in mind how the buyers and sellers need good quality buyers and sellers to make that deal ultimately happen. And here's a graph over there on the right that shows kind of the volatility, the ups and downs of house prices. And we'll flip to the next one because there's another graph that shows that as well. This one goes from 1890 almost up until now, talking about the same $100,000 house in 1890 wouldn't be worth tremendously more now, just about 14% more. And that's kind of because house prices traditionally over the long term go up about 3% a year. So they basically just keep up with inflation. As far as individual stocks, some of the things that make those investments volatile are going to be, of course, the sales and the profits of a company and how that company grows. If you hire somebody new or you're purchasing more companies, that's going to affect it. Also, there you see new concepts. The good example there is iPhone and Apple. iPhone's almost 70% of the profits for Apple. So if anything happens to that income stream, it's going to have a huge impact on that company and the stock. Not keeping up with the times. A good example of that is Blockbuster and Netflix. Some people are going to remember Blockbuster when you'd go out and you'd rent a DVD, or some people might even remember when you rented the VHS tapes. But now you have Netflix and online streaming. And so like my kids don't even remember the VHS tapes. They remember Netflix and how to get that online. I think Comcast does that now. And Amazon's the other one that does that. And so they've made changes to keep that business successful, but Blockbuster didn't make those changes, and they've kind of felt the effects of that and are no longer in business. I put emotion up there too because that's something that we talked about earlier that's going to obviously affect the ups and downs and the volatility of that stock. You have some external causes too, media, if you have sensational headlines in the news or on the internet, and our pundits on TV are going to dramatically affect how a single stock performs. Other things, Global economy, lawsuits, and government regulations and different laws are also going to affect what a stock can do. And the stock indexes, that's just a combination of a bunch of different stocks. They're going to be affected by bigger influences like quantitative easing, stimulus, or some type of natural disasters, man-made disasters. And this one here shows, it's a graphical representation of kind of the volatility of the returns every year of the S&P, just showing how that goes up and down. And I liken that to kind of the feelings and the emotions that people are going to have, or the families that are invested kind of feel that same thing, because that affects their finances, you know, and possibly their retirement as that goes up and down. Mutual funds, very similar to individual stocks and the indexes. They're just a combination of many different investments. Over 7,000 of those. Once again, some of the things that we're all invested in, maybe through 401ks, retirement plans. I didn't mention electronic trading. ETFs have been around for a while, but the markets are doing good, so they're a little more popular now. You combine that electronic trading with the speed of information, there's a lot more volume of trading going on out there, so it increases the frequency of that volatility. These ones down here are not so much volatility, but things to think about when you're looking at mutual funds, trying to figure out which one's going to be the best one to make part of your investing. Consistently over time, most mutual funds aren't going to beat the market, and those are ones that are even managed by professional people. Half of mutual fund managers don't invest in their own funds. So this is something that I look at when I'm trying to figure out who I'm going to work with, what investments I'm going to make. It's hugely important for me, because if someone's asking to invest my money, telling me this is a good investment for me, it only makes sense to me that they're also investing in that same thing. Well, I guess an example of that would be you would never want to go into an airplane with somebody flying it who's never done it before. So they basically need to do what they're recommending to you. They need to be doing that stuff on their own too. Mutual fund fees, they get typically front loads, back loads. They'll get an asset management fee. There's lots of different fees they get, irregardless of the performance of the fund itself. Fees will be anywhere from 1.5% to 3%. ETFs will be a little bit lower than that, but they directly impact your return. And we'll show this graph here that just shows what the effects of a graph, or the graph shows kind of what that fee will be. The red lines, of course, after the fee, the blue lines before. So the difference is the impact that that fee has. And as your portfolio grows over time, the compounding effect of that impact is pretty big. Starting off a $100,000 fund, at the end, this affects you by almost $375,000. Collectibles, those are going to be things that you've acquired over time, things that people have passed on, family and friends that you now have. And those are basically only worth what someone's willing to pay. Kind of like real estate. A seller may think that house is worth a lot more than that the buyer is ready and willing to pay. So you got to bring those values together to sell it. You could be trying to sell that in a liquid or a down market. You may not even be able to sell it, let alone kind of what you're trying to get for it. And something, of course, might be desirable today, might not be desirable tomorrow, and you're going to have emotional attachment to some of those things, like wedding rings. That's a pretty common one. And then if you lose it, it's going to go down in value. Good example of that, the picture you see there is a car. And just to touch on volatility, is it always bad? No. More than half the Fortune 500 companies started during a recession. Some big examples that we can all relate to is GE, started in the 1800s, FedEx in the 70s. So you may think that a company would want to start when the economy is doing great, but also just because it starts in recession, it's more based upon, is that company providing something that's valuable to people and something that they need. That's probably going to be a better determining factor for whether or not a company will be successful. Some reasons why. If you have money, everything's going to be cheaper when the market's down. Extremely motivated. The people working in that environment are going to be very motivated because they have to be successful. If you guys have ever worked with maybe some coaches or some mentors, I've heard some of them say, I'd much rather work with someone who doesn't have a job, because that person is going to be much more motivated to be successful and take the action that's needed. There are going to be lots of employees out there looking for work, so it's going to be very competitive, but you're going to have good ones out there. The flip side of that is you're probably going to have less competition for your business. And depending on the market, you may have access to lower interest rates and cheaper credit to help grow your business. As far as real estate, there are some investors that can do very well in difficult economic climates. You have to be careful. I say some, because if you're a real estate investor and you have one strategy and then the market goes a different direction, it might be very hard for you to continue to be successful with that one investment strategy. What can you do about that? We always recommend people get out there, communicate with other investors, talk to them, find out what strategies they're using, see if you can bring those into your investment strategy. In case something ever happens with the market, you're going to have a different way to be successful. Buy cheap, hold, sell high. That's pretty much going to be a tried and true statement strategy in any type of investing that you do. Buy long-term hold at the bottom of the market. That's pretty much, when people say you make your money when you buy something, that's essentially what that is there. You're buying good value. You can also do owner financing. A lot of people look for people who have 100% equity in their home, get it under contract. Another strategy is subject to financing. That's something that we like to use. That's essentially when you get a house under contract with the loan in place, then you end up doing a wrap mortgage on that house and you get the monthly cash flow. That can be really effective in a down market when there's a lot of people out there that are kind of a little bit underwater in their house. As the market increases, there's lots of guys out there doing rehabs and wholesales. You're going to find good deals on that, especially when the price and value of the home you're looking at is going up as well. You're always going to have a lot of people looking to rent at the bottom of the market, especially if it's a housing crash because they probably got out of their original home because they couldn't make the payment or foreclosed or something like that. The one thing with real estate, as you guys probably know, you got to be involved. A lot of energy in the investing, so especially if you're transactional business, if you only make money when you're making deals. So you have to be out there talking to buyers, talking to sellers, and making those deals happen, doing lots of marketing. Similar type stuff in the stock market, the same, buy low, sell high. That's a strategy. You're working with the volatility in that, but you can do that, but you got to be careful. You can always look for and invest in the up-and-coming stocks, the ones that still have a lot of growth up ahead of them. Make sure when you use those two strategies, though, you're doing your due diligence, you're doing research, and you're checking out the companies. And if you find one that's successful and you want to diversify, a good way to diversify is among similar companies that all have the same strength that you're looking at. Invest in a couple different of those companies. And just understand the risk associated with doing that. You got to pay a lot of attention because a lot of the professionals do have trouble doing that. That goes hand in hand with being involved. Just doing your research and doing your due diligence on the companies and the stocks you're going to be investing in. Something you want to think about is kind of staying away from that herd mentality when the market goes down. It's a buy low strategy, so when it's a great time to leverage your purchasing power when that market goes down. And a lot of the reasons that people do that is because people jump out when the market goes down, then they jump back on when the market goes up. And that's just an emotional response to that volatility. And so as investors, you just need to control and kind of manage those things. Manage that volatility and manage that emotion. Some real estate strategies to help with that volatility. You can always be the bank. You can hold the note instead of the title. And one of the advantages to that is you don't get the calls when there's something wrong with the house. We show there the leak and fix the water heater. You don't have to worry about tenant issues. You don't have to worry about vacancy. You basically collect the interest, or if you have a wrap note, you collect the spread in between that every month. You may not have the equity in the house, but your monthly cash flow is stabilized. And remember, if you're holding real estate for equity, it basically rises about the same as inflation. And Brian and I have done both of those strategies. We hold notes on real estate. We recently just sold a block of houses because we wanted, they were actually rentals, and we sold those because we wanted to transition the money we made from those rentals into a different type of investment where we ended up getting the same return, but we didn't have the same volatility. And that's kind of why I talked about multiple strategies. Think about having rental properties. Think about maybe having notes too, just to stabilize some of that income. You can hold your rehab if there's a big hit to your ARV. And what that makes me think about is for those guys out there doing rehab with hard money loan. Because if there's a hit to the market or something, your exit strategy might change a little bit because maybe the value goes down by 10, 20, 30%. So just think about having maybe an A exit strategy and a B exit strategy just in case if something unexpected changes. Some of the ways you can do that is to have a couple different financing options. Banks, that's good because those are low rates, but sometimes you can limit out on the loans you have and they can be very challenging to get. Hard money, that's short term but pretty expensive. Another option you have out there is a personal lines of credit. A lines of credit is good because you don't pay points on it and your interest rate is probably going to be lower than most of your hard money options. And it's a revolving line, so it stays there. You use it, you pay it off, you can use it. So you can go as many times as you want. This is something I've done. This is something Brian's done. I recommended it to a real estate investor a couple months ago, and he used it as well. There's a strategy out there. You can go and get $100,000 in lines of credit in a single day. Like I said, we've done it before. It's a very good option to have. So if you guys want to do that, we can walk you through kind of how that works. We'll remind you again at the end of the webinar, if you want to do that, just give us a call, send us an email, we can go through that with you.
All right, so this is Brian. So question for you guys on the phone here, how would you like to earn 25% on your investments? Well, of course you'd like to earn 25% on your investments. Who wouldn't want to do that? But you need to put that in perspective. And it depends. So as an example, let's say you start with a $100,000 account. In year one, you earn 100%. You have $200,000 in your account. In year two, you have a 50% loss. You have $100,000 again in your account. Let's say in year three, you earn 100% return again. Well, you're back up to $200,000. In year four, you have another 50% loss. You're back to $100,000. You end with $100,000 in your account, which is actually what you started with. But your average rate of return is 25%. Did you actually earn 25%? Not exactly. I think you earned zero. Now this, of course, is a drastic example to paint the picture. But this is how the stock market or most mutual funds report their return. So the return you get on your mutual fund might not be what you actually are earning. So when you hear that your IRA or 401k got 12% return, you need to ask yourself, how much did you actually get? Because it's not your average rate of return. Let's go through an example of what that actually looks like. So here's the example. You have a portfolio, say it's an IRA, mutual fund, 401k, etc. Assume that your portfolio has $500,000 invested in the S&P, and you're going to use this nest egg for your retirement, or to supplement your retirement. And we'll use returns from 1969 to 94. The reason why we do that is because, like the past 100 years, that block of 25 years is the least volatile returns in the S&P. Now let's assume that you take out $30,000 per year, and you take an additional $3,000 out per year additionally for inflation. This is what that looks like graphically, or in a chart. You can see here your returns you're getting per year. Over these 25 years, you have 6 losses, but you have 13 years that are over 12% returns. And you can see through here, you have multiple years that you have over a 30% return, which is amazing. Your average return, average rate of return, once again, is 11.3% over that time. I wouldn't call this your real return. We would call it your average annual return. So once again, 11.3%. This is what that looks like graphically. You can see the volatility of this as it continues to go down. You also got to be aware, if you're withdrawing $30,000 on a year where you lose money, or you lose on your return, you actually compound your loss. So you can see that at the end of the 25 years, you have $19,000 in your account. You'll be basically broke. So in this example, you only have $19,000, but what can you do to have $3 million in your account instead of $19,000? Well, you remove the volatility. So this next example shows the value with a fixed return instead of a volatile return. So you can see here in the one column you have 11.3% return every single year. You don't have 30% returns. You also don't have any losses. At the end of it, you can see you have $3.02 million, and you're still withdrawing the same exact amount every year as the previous example. And your average return is exactly the same as the previous example, 11.3%. In one example, you're broke, and in the other example, you're a multimillionaire. So you can see how this one, your net worth is growing exponentially, and it's going to keep right on growing. So once again, in this example, volatile returns, you're going to be broke. In this one, you're a multimillionaire, all by removing the volatility. So next we're going to go through some of the experiences that we've had in our investments that we kind of want to pass on to you and hopefully get you guys some awesome value. One of the things we've learned is that it's not so much about removing the volatility. Obviously it's a good thing, but it's more about understanding and reducing the volatility and working with it to help grow your investments. Additionally, one thing people don't realize is the more liquid an investment is, typically the more volatile it is. A great example of this is a lot of investors want their investments to be liquid so they can pull their cash out quickly whenever they want to. But the result of that often is that the investment is very volatile. A great example is the stock market. You can make trades, you can sell and buy shares almost instantly nowadays, but as everybody knows, the stock market can crash in a single day. It goes up and down every single day. You see it in the news always. Basically it has drastic changes on a daily basis. But it's also very liquid. You can pull your money out of the stock market very quickly. Now compare the stock market being liquid to, say, real estate. Real estate is considered a liquid investment by some, but it's not nearly as liquid as the stock market. As an example, if you want to sell your real estate, you can't just go sell it within an hour. It can take you time. It can take up to 30 to 60 days to sell it. But at the same time, it's not as volatile as the stock market. It might take 60 days to sell it, but you're not going to have your real estate crash in a single day, obviously barring that it didn't burn down or there was a flash flood or something. But compared to the economy, it's not going to change as drastically as the stock market in most cases. And then diversifying multiple strong assets. You know, obviously, everybody always talks about diversifying, but it's not always enough to diversify. Mutual funds are typically very diverse, but their returns don't even beat the stock market, as we previously mentioned. You need to invest in strong assets, not just multiple assets. Diversity in your assets should be used to maximize growth by not limiting your investments. So I always say don't think of it as a way to minimize loss. Think of it as a way to actually maximize your growth. And then be prepared to move quickly when an opportunity becomes available. I can't remember how many people I've come across who have said, oh, I had an opportunity, but I decided to pass on it. I shouldn't have done that. And we've always heard that. So I would say if you want to invest, be ready to do it quickly. One of the things that we've learned over time and through our investments is that we want to make sure that we're turning our converting our earned income into passive income. And this is where we have our money work for you, not the other way around. I've met many investors that were getting burnt out with their investment strategies because they stopped working. If they stopped working on it, their income evaporated. Their money was not working for them. They were actually a slave to their income, to their money. So we have always tried to make our money work for us via passive strategies. And the way we do that is investments that are less liquid. They're not the stock market. This provides extremely stable growth over the long term. Some of these investment assets that we use are online businesses, oil and gas, discounted debt, and real estate, of course. And these all provide passive income based upon our earned income that we invest in these strategies. Oh, and I want to actually say one thing right here that is an interesting story. Years ago, I was working for an employer, and like most employers, they had a 401k provider, and I was part of that. but I was actually investing most of my investment or my retirement income in the investments you see here: online business, oil and gas, debt, and real estate. That's where I was putting most of my money. I was not putting it into my 401k. So they invited this 401k provider into the office, and they would sit down with each employee and talk about their investments and their retirement. And so I decided to go talk with them. And I sat down with their head guy, and this is a pretty big company. Everybody would recognize the name. And he said, "Oh, so let's talk about how you're going to retire on your 401k." And I said, "Well, hold on a sec here." I actually am not investing in my 401k. I'm investing in different things. He said, "Okay, well, what's that mean?" So I explained to him what I was investing in, how I was doing it, the returns I was getting, and what I had experienced so far. And I asked him, I said, "So based upon what I just told you, should I actually be taking that money instead and put it in my 401k with you?" And I'll never forget this. This guy, he was not a young guy. He looks at me and goes, "Do not invest in your 401k. Continue doing what you're doing." This was amazing to me. That was a pivotal point in my investment career, that a guy of this company told me not to invest with him, and he was managing this mutual fund, is what it was. So you saw in a previous slide where you heard that most managers don't invest in their own fund. That sort of shocked me that he said that. So I continued obviously doing what I'm doing and have done very well in it. Some other experiences that we've always wanted to pass on is that you need to know what your goal is for your investments, because only then, once you know your goal, can you actually put a plan in place and a strategy that actually is in place to meet those goals, and actually you can measure your success on your path to meet those goals. We meet many people that are investing in a 401k, but they don't really have any idea of how it's going to grow and how they're going to retire with it. They assume that something's going to happen at some point down the road and they're going to be able to retire. Well, that's a pretty dangerous way of thinking. We always recommend find others who are successful in the same areas that you want to be successful in. Don't reinvent the wheel. There's other people out there that are doing the same thing. Find them, learn from them, try to have them mentor you. That's one of the things that we have done very well, and it's been great. And we've learned a lot from a lot of other people. Additionally, it's not about getting rich quick. It's actually about building long-term growth and long-term wealth. And why we say that is because everybody's heard the story of people that got rich quick and also got poor really quick. You want to build long-term wealth that you can actually pass on to other people. And then be willing to help others and pass on what you learn. That's one of the things that we have done quite a bit of, is just trying to help other investors and other people, whether it's family or friends or coworkers or whomever, just helping them out. We enjoy that. And then growth accelerates when you're working together, and that's we've experienced that in the real estate market and all the markets. If you work with other people, pass ideas on, help them out, guaranteed you're gonna all grow, not just individually. So that being said, that is the majority of our webinar. If you guys have any questions, please feel free to type them in. We got a couple of questions so far that have come in. We'll go ahead and answer here in a little bit here. But if you have any questions about our investment strategies, what we've discussed here, please feel free to give us a call. We love sitting down with other investors, talking about it. We love sharing our experiences and providing value to others. It doesn't matter what it is. As an example, if you want to talk about the $100,000 in lines of credit, that's an awesome strategy. It was given to us by somebody else who's done it before. We know other people who have done it. It's phenomenal. If you want quick cash, access to quick cash, it's a great one. So feel free to give us a call or send us an email, and we can discuss that with you. So with that being said, we'll go through some of the questions we have here right now.
Let's see. Bethany, where are you located, and do you work with investors out of your area? So, yep. Where are we located? Yeah, we're located in the greater Seattle area. Brian's more in the Seattle area. I'm a little bit farther south in Olympia. And I do travel up here to meet with investors and vice versa. And we certainly work with investors from all over, everywhere. Seattle area, Washington, the whole country.
And then Lance here is asking us, what does our investment fund do? Well, our investment fund, it's a stable place for investors to put their money that removes the volatility, using the principle that we just went through in this webinar. So it's an opportunity for other investors that are looking to do some of these things. So I'd recommend if anybody has any questions about that fund or what it does, just feel free to give us a call or send us an email.
Mitch, do you actually use PLOCs or personal lines of credit to do deals? Um, yeah, absolutely. Like I said, I've done that. Brian's done that. I've recommended that to a couple other people. I know one actually went out and did it. So, and certainly we have done it. It definitely works. So, like Brian said earlier, if that's something you have questions about, just give us a call. We can walk you through um, exactly how to do that.
And then Conrad here asks, this is a good one, do you guys have any investments in the stock market? Listen, Brian, the only way I've invested in the stock market was through an employer, not by choice. And Jake, you meant answer that question for you.
No, I don't have any active investments in the stock market.
And we honestly we don't foresee doing any investments in the stock market. We outperform the market in our current investments exponentially. So it is not something we actively are invested in right now, and don't foresee that we'll do that. So.
No, it looks like that's it for the questions.
So if anybody has any other questions beyond this after this webinar, feel free to go ahead and give us a call. But I'd like to say we appreciate your time. We know your time is very valuable, and I hope this was informative for you. And we'll be doing some webinars on other topics. If you guys have any topics that you'd like to see or hear about with related to investing or anything, feel free to send us an email. We'd love to get some ideas.
Yeah, to go along with that, please do that if you have any suggestions you have, because it's always good for us. If it's something we don't know about, doing research on it and doing a webinar on it is also valuable and educational for us. So certainly appreciate that if you do have any suggestions.
Oh, and then we just got another question. Do you recommend using a PLOC at a fixed rate lower than the fixed return you guys give to invest in the fund?
I think I understand that.
So if I think what you're asking is if you're able to get a PLOC, say at like say 7%, and our fund pays investors a 10% return, is that a good investment? We'd have to run the numbers on that. There are two different. Those interest rates are actually they're calculated differently, but that's a great question. I'd have to actually sit down and go through the numbers on that. But feel free to send us an email on that one, and we can run the numbers on that. And then, yeah, and Robert said, you're welcome. I appreciate thank you. And any other questions? Do you think that was it? Jake, when you look at his question about the fixed rates, does that make sense to you, the answer?
Yeah, I think so.
Yeah. Yes, we'd have to know the numbers on that one. Because between us, we probably have, I'm guessing, 10 different lines of credit.
And just so you guys know, when you do lines of credit, each line of credit is typically going to be a different capacity and a different payment structure and different minimum payments. You have different interest rates, different minimum payments, and so you quickly find out when you get those which ones are going to be the most advantageous to use. Because I use some, I focus on the minimum payment, and some I'll focus on the lowest interest rate. It just depends on which ones you have.
Yeah, that's actually a really good question. I was looking at one of mine the other day, and it's interesting. It has a high interest rate, but the payment is fixed for 5 years. It doesn't matter; it's just fixed. Whereas the other ones are variable. The more you pay, the less your payment is. Whereas this other one, it's just a fixed payment the whole duration. So you definitely have to look at that on an individual basis for each one of those. But we've used our PLOCs for a lot of short-term investments. We've used it for real estate, short-term loans. There's lots of different uses for them. So
yeah, I just think it's a quick way you don't have to worry about and go asking people for hard money or private money or anything like that. It's just a quick way for you to do it on your own where you control it. And once again, the great latitude is it's a revolving line of credit. So it doesn't go away. You can continually use it and pay it off, which is a great advantage to have.
Yeah, it's a good one. Yes, we actually are going to both. So we have them through Boeing Employees Credit Union, Seattle Met, Harborview Credit Union. Actually, the credit unions are great, but the overall strategy is you do it basically in 1 or 2 days for certain reasons. So yeah, we do.
Yeah, so Robert, if you've got questions on that, give us a call and we can walk you right through that structure.
Yeah. Okay, well, I think that's probably it, guys. Once again, appreciate the time. Feel free to give us a call or send us an email on anything you have, and look forward to seeing you guys in the next webinar.
All right, thanks a lot, everybody.